Welcome to the Sheth Leadership Academy lecture series, where Professor Jagdish Sheth, one of the top management thinkers in consumer behavior, competitive strategy, globalization, and changing demographics, presents on a variety of topics such as this lecture, titled, So You Still Want to Be an Entrepreneur.
As you know, there is a significant interest worldwide, both in advanced economies and in emerging economies, that entrepreneurship and innovation are really the way to grow the global economy. I also am a very strong believer in entrepreneurship myself. I have been an academic entrepreneur. Also, I've had a couple of businesses. Entrepreneurship is probably the real competitive advantage of a nation. Entrepreneurship is universal. It does not recognize gender. In fact, some of the best entrepreneurs are women. It does not recognize literacy. You may be a top scientist in a university and spin yourself out as an entrepreneur, as we have seen in the Silicon Valley, or you can be the most illiterate people and be a great entrepreneur. Entrepreneurship does not recognize ethnic background. We have entrepreneurs from all kinds of faith-based backgrounds, ethnic backgrounds, no matter where you are in the world. It is probably the biggest universal positive force. My view is that it is better than capitalism. It's the entrepreneurship, which is not the same as capitalism, that really revitalizes nations, that really in fact gets more wealth creation among everybody. It is also probably the best democratic or democratization platform for wealth creation, for contributing back to the society, no matter how you look at it. So I feel entrepreneurship is even a stronger force than capitalism. Entrepreneurship can be, of course, across all walks of life. You can be a social entrepreneur, for example. You could be an academic entrepreneur, for example. But this lecture is primarily for business entrepreneurship. The lecture has really two parts. The first part is to say, in the dot-com boom area in late 1990s, why so many failed, why it became a bust, and what lessons can we learn. So the title of the presentation, So You Still Want to Be an Entrepreneur. The second part is to really learn from all the lessons we have learned from business experience, especially among entrepreneurs, and come out with a set of observations and a set of recommendations. So part of that will be descriptive, as we call it in the academic world, and part of that will be prescriptive, essentially. And hope to conclude this lecture by simply giving you the summary of the same comments back again. So let's start the journey. The first slide says it's deja vu all over again, as Yogi Berra, who is one of our wisest men in terms of coming out with precise definitions of a problem or an issue. And he always used to say it's deja vu all over again, which is a repetition of the same thing. The dot-com bubble and subsequent bust is nothing new. That's the first thing we observe. It happened before and it will happen again. We had a banana bubble. Think about that. We had a corn bubble. Think about that. We had a railroad bubble also. We had the automobile bubble in the early 1900s. We had 450 car makers. They all jumped in the automobiles and most of them had a shakeout, mergers, collapse, etc. Capital markets, however, do not sustain speculative bubbles. So the last bubble, which was a technology-based bubble, what we call the dot-com phenomenon, was strictly speculative market. It's not sustainable. If you want to make speculative money, then create a new wave of speculation, create a big wave if possible, and then you get off the wave before everybody else crashes. So you can create a wave on whatever is the latest fad, fashion, latest obsession, such as alternate energy, for example. Or the latest obsession would be online education. It doesn't matter. But then that is not an entrepreneurship. That's just investing. That is just, in fact, making money speculatively, almost very similar to insider trading. It's not real business in the way we think. So I try to analyze as to why we got this irrational exuberance in entrepreneurship in the 90s, especially in the Silicon Valley. The first major lesson we have learned is that unlike the industrial age, let's say about 100 years ago or 150 years ago, the digital age has very, very low entry barriers. Whether those are infrastructure barriers, especially after the evolution of the internet, there are highways, information highways, just like we build the railroads and we build the typical highways in this country. Capital barriers are relatively low compared to 100 years ago, for example, in the industrial age. And the talent is more available, although there is a talent shortage, but it's a combination of shortage and surplus at the same time. It's a really matchmaking problem, more so than a chronic shortage of talent. My estimates are running that the entry entry barriers are in the digital age or the internet age is at least 100 times less than what was true in the industrial age, which means anybody can jump in. And when many people jump in at the same time, you create a bubble. Right now we see the bubble about social media. Mark my words, there will be a shakeout in social media also. There's a bubble about everything. So these bubbles are very perennial issues. And historically, economists have analyzed about why bubbles begin and why they collapse. Second major reason that happened was that the techies and consultants, rather than remaining specialized as engineers and scientists, techies, or as consultants, advisors, became entrepreneurs. Not because they were passionate about entrepreneurship, they had no skill set, no competency even, but this is to make a quick buck. And since so much of capital was coming in the dot-com era, I mean, you even could have just a vaporware, a PowerPoint presentation with nothing solid behind and get 10, 15, 20 million dollars of capital. I saw that. And that was the second reason why we had an irrational exuberance. We see money, unfortunately, corrupted the expectations. The normal expectation would be that you will work very hard, create a successful business, get positive cash flow, and run the business forever, hopefully with a succession planning where your partner, your children takes over the business. That's typical family business entrepreneurship. But we see capital says, I invest now, but in 3 to 5 years, I must exit. And by the way, I can give you this speculative valuation. And unfortunately, those speculative valuations became outrageous and they collapsed. So we see money corrupted the expectations as to how big the valuation would be. For example, there is no way you can ever justify the Facebook valuation when they did the IPO of $50 billion or more. That's just ungodly. It's actually irrational exuberance. It's not sustainable. And we have seen that many companies, especially in the dot-com era, who get the venture capital money and then they will do a much sooner IPO than they should do and exit. You get the valuation on the first day of the trading, maybe a week, and then the stock collapses. Consistently, I've seen that pattern. IPOs were also easy to do. In other words, we even created stock exchanges like NASDAQ to allow smaller amount of capital raising. London Stock Exchange even came out with a stock exchange called AIM, which would even give you micro public capital, like a micro lending, interestingly. Japanese did the same thing. And I think therefore going to an IPO and exiting became so easy. On paper, we were all millionaires, but not in the real world. High equity valuations that came through speculative IPOs of large enterprises created cheap currency for acquisitions and mergers. You basically say, all right, if I don't have the scale, let me buy out another guy who is competing with me. We combine together and do the IPO. And VC guys will orchestrate that because they invest into all competitive companies. I believe venture capitalists have no loyalty to the founder or the entrepreneur. They have loyalty only to their investors. Software-based businesses were easy to clone and creating a herd mentality. In other words, especially application software as opposed to operating systems, infrastructure is there. All I need is a smart couple of people to come out with a software application. Have you seen how many applications we have on iPad and iPhone? I mean, it has exceeded 200,000 applications. Any ordinary activity that I know is time consuming, is irritating, it's a nuisance, I can always have an app. We have app for everything in life now. Mundane routine stuff that we used to put up with all of the irritations and hassle, apps can make it easy today. But that means everybody jumps into that one, creating that speculative wave and a herd mentality which says shakeouts and mergers will be inevitable. And while internet, like any technology, is a wonderful, wonderful technology in transforming our lives, probably it has transformed our lives more than railroads did way back when, or highways did later on in the 20th century, last century, for example. Internet is much more powerful because of the two very key dimensions. It is a very rich medium. It can converge very disparate languages and very disparate data content, whether it's a voice data, or a video information. So in the information technology, it has a power that's unthinkable. And reach is very large. I can reach at the same time, same place all over the world by sending an email out or a broadcast of some sort. Those are very important characteristics of the internet, but the internet, like any technology, has huge side effects. One of the side effects is that it makes you an entrepreneur even though you may not be ready to be an entrepreneur. We really truly do not have skill-based entrepreneurship vocational technical training programs. We do have undergraduate business degrees. We may have some entrepreneurship peripheral extension in engineering, for example, where a lot of entrepreneurs come out because they're techies. They know how to do it, but they have no business sense whatsoever. And of course, they want to do it part-time while being students. Entrepreneurship is a 24/7 business. Unless it's an obsession, there is no way you will ever succeed, because that same entrepreneurial desire will become a nice hobby. So you gotta give up your regular livelihood or regular career such as an education in order to become entrepreneur. So one of the side effects of entrepreneur is to inspire and aspire lots of people who had no competency to be entrepreneurs. So now let's look at what we have learned about entrepreneurship over time. And by the way, these principles are true about business in general, not just entrepreneurship also. I've done enormous amount of research in this area, especially about half a dozen points I will make, and I'll point out the research that I've done. But the first one is very obvious. Everybody will tell you that business success is only 1% inspiration and 99% perspiration. You can't go to heaven without dying, please. There are no shortcuts in life. And more people get into this entrepreneurship like speculative investors and simply say, how quickly can I make money and how quickly can I cash out? That's not entrepreneurship. Entrepreneurship says that you create value for the society, value for customers, and in the process value for yourself, and you want to be in that business forever. So it is main thing is a lot of hard work. And as I mentioned, it is 24/7 business. One of the things we find, especially with people who have been corporate employees and want to be entrepreneurs, is that they were never understood that as corporate managers, they are not owners. But when you are an entrepreneur, you are the owner, and the burden of ownership, the accountability of ownership is so strong that you have more sleepless nights being an entrepreneur than you have as a manager. And by the way, there is no Monday through Friday 8 to 5 work schedule. It is 24/7, as I have said several times. Second point that I've observed is that the best inspirations for starting a new business come from frustrated or unhappy users of existing choices. In other words, if you look at the inventions, most of the inventors were actually frustrated users, and they found nobody had a solution for their problem. And they came to the belief that if they have a problem, there are others in the society, others in the market who have a problem, and therefore there is a market opportunity. But they did not do it for market reason. They did it because they wanted to solve a societal problem, a personal need. Most inventions have come from that. Whether those are corporate laboratories creating inventions with a very focused, targeted, mission-driven innovation, or whether those are in fact necessity is the mother of invention, as we say, where the users find there has to be a better solution. You have to have that kind of a understanding to be an entrepreneur. Third thing, I have observed that entrepreneurship is a marathon race. It is not a 100-meter dash. What do you need in a marathon race, therefore, is slow-burning fuel or energy, what they call complex carbohydrates, so you can run long distance. You don't need a quick sugar intake, which is great for 100-meter dash. And what you need, therefore, in marathon is what is called pasta. And the pasta for business is cash. So you have to be very, very careful about cash flow management, cash flow conservation. The problem is that if you have no experience, and if somebody gives capital for growth, we waste it. I've seen that again and again. Rather than conserve the capital and therefore increase the runway, so how can you perspire a lot, and how can you actually in fact do at a very low cost basis what is called frugal mentality or frugal entrepreneurship is the only way that one actually succeeds in the long run. Most successful businesses therefore start in a garage or a basement and not in lavish offices with expensive infrastructure. And this was my observation. I was shocked. A person who has just an idea, PowerPoint presentation, vaporware, gets $10-15 million, and the first thing they do is to buy a very large office space or rent it, all the furniture, as if they will have 100 people working when they only have 4 or 5 people. But I need it now for future expansion. Isn't that interesting? And it fails miserably. If you take today's best corporations and if you go back to their early humble beginnings, most of them, almost all of them, began in a garage or a basement. That was true of Whirlpool Corporation in the appliances business, where the Upton Machine Company and Upton family created the automatic washer like Maytag did, struggling enormously in the beginning. But that's also true for Hewlett Packard. Surprisingly, that was true for IBM. I mean, I can give you examples after examples of any industry where the best corporations today all had very small, humble beginnings and a lot of struggle, actually. Most successful businesses are made by one customer, not even one or two, as the slide says. They are not made by the size of the market. And more than 50% of the time, customer discovers you. You don't even discover the customer. So planning this one out on secondary data, the excitement of the analyst saying that how big this new opportunity is, like big data now everybody talks about, for example, whatever it is, it's just a mirage. Ultimately, what matters is getting the first account, which is a revenue generating, and actually the customer nurtures you so that you come out well. This is the Japanese saying that a customer is like your parent. He will nurture you and you will grow up to be a good citizen, a good human being, better than probably what your parents can do. So it is only one or two customers that you need to identify, go after them, or actually in fact they will identify you. And I've done this research. Every time I'm asked to invest into a company which is a startup company, that's the first thing I look for. Do they have one account for a long haul? They were going to nurture that. Back to that Whirlpool example, the customer was Sears Roebuck. Same thing happened with Daimler-Benz. You had two great inventors, Carl Benz and Daimler. I don't remember his first name. They were both merged by the government, and really surprising to all of us, their first customer was a Russian Jew who was fleeing the revolution of 1917 when the czars were being thrown out and communism was coming, and he came to France, which was the country everybody went at that time, and he asked to buy 34 Mercedes-Benz automobiles and made one strong, not only request but a demand that the car cannot be called Daimler because it was identified with the Germans. And Germans were not liked in World War I, for example. So he said, I want to call that as Mercedes. Why Mercedes? That was the customer's daughter's name. Think about that. And rest is history. Mercedes-Benz got a second break. Car was very well built, very durable. There was a head-on collision in those days. As you know, if you could afford a car, you could afford a chauffeur, just like horses and buggy days. You didn't drive your own horses and buggies. And therefore, in this head-on collision, the other party dies, the car is demolished, but the person sitting in the back in Mercedes-Benz walks out unscathed. Nothing happened. And that turned out to be Adolf Hitler, who simply said, this is such a well-built car, the company is so good that I will bless it as my government procurement business. So that's why Mercedes-Benz went into, for example, diesel engines, industrial vehicles, essentially, almost making tanks kind of a thing. Most successful companies die, next point, is at least once they die that I know, and often they die 2 or more times. So accept the theory of reincarnation. Believe in that Eastern philosophy. You will be reborn. Not for paying for your karma or the benefit of your karma. It's not the theory, but the theory here is primarily saying that you will have collapse of the company and therefore you need to learn how to survive. No entrepreneur has ever become successful without a survival instinct ultimately, and you get from an early setback. Whether it's a cash flow problem, people who joined you leave, for example, customers are not willing to pay, you are struggling to find customers, whatever it is, whatever hardship you get, there is no character building in life than strong hardship. And great entrepreneurs have gone through strong hardships either in their childhood or while being an entrepreneur. Point number 7. The first mover advantage we all teach and practice in business and in marketing is really again one of those illusions. The first mover advantage happens or works for you only when nobody is allowed to follow you. And that's because there are patent laws that does not allow anybody to duplicate, or there may be capital requirements that others cannot join, like in the industrial age. If there are no entry barriers for others to follow you quickly, then the first mover advantage is irrelevant. In fact, I have analyzed industries after industries where the first wave of pioneers and entrepreneurs or inventors all lost money. It's the second wave of investors who made money, such as, for example, in video games. Atari Atari, Intellivision, they were all startup companies, and they all died when the customers and their customers, which are OEM video game makers, like a Sony, for example, they all actually, in fact, went away from Silicon Valley to obviously Japan. And they began to buy semiconductors, a 4-bit, a 8-bit, maybe a 16-bit processor, not from the Silicon Valley companies. Intel was a failing company because they were making semiconductors at the low end for video games, typical consumer products. And they were made who they are, just like any other example, by IBM. So was Microsoft, as we know, in the PC business. Great inventors are usually poor entrepreneurs. I've found that again and again. And great entrepreneurs are usually poor managers. That's a very predictable phenomenon. So you have to make up your mind, are you an inventor or an entrepreneur or a manager? There are very few people who can be all three. It does happen, of course, but it is very, very small probability or a rare occurrence. Most inventors are often so control freaks that they worry everybody will steal their idea, everybody will steal their invention, even though it may be patented, and therefore they simply don't allow others can delegate. Entrepreneurship is all about leveraging others, leveraging the capital markets, leveraging the talent market, leveraging the customer, leveraging the supplier. It's basically a skill set to organize and gather resources to deliver the business or the product or the service. And I find that most entrepreneurs are really not good managers. So they can do very well in the beginning, but when the company grows in a larger size, they have run out of processes, they are unable to institutionalize. It is still the founder's shadow that carries the company. And they become, unfortunately, very much orthodoxy driven, legacy companies. And the founder is unable or unwilling to change with the change in the times. So after starting a company, you have to make sure that you are able to delegate to a professional manager as a number 2 person who will do all of this bureaucracy work, which entrepreneurs hate bureaucracy anyhow. It's a perfect combination to have a 2-people organization pretty much. And by the way, the worst managers are consultants and advisors like me. We all think that because we give great advice to companies, we should be able to jump into that business and succeed in that business. Absolutely another mirage, another myth out there. It just does not work. We believe that thing, but it is very rare to see world-class consultants in large companies coming into the client organization and then running the company. I have not seen too many ad agency people coming into the clients for whom they design or create creative ads and then run the companies. I have not seen the market research companies, consultants in that area, coming into their client organization and actually running a large enterprise. Next one. If you treat the business as your monthly employment check, most likely you will not succeed. If you create a business to attract outside capital with the expectation that you will make more money than your corporate salary, you will be almost dead on arrival. Remember, we talked about pasta, cash. You should be the least expense on the company in terms of a cash flow, outflow essentially. And most consultants and most managers, when they want to become entrepreneurs, expect the same corporate salary, the same corporate benefits, and it becomes an overhead on the company to a level that the company collapses. It's such a small startup company. Often it is not good to be both an owner and an employee. So my view is that you've got to make up your mind. If you're an entrepreneur, are you an owner and you put your sweat equity, do the work without compensation, but you make money through the value increase in ownership? So if you start with a stock price nominally on a piece of paper at $1 per share, how can you put effort behind, get everybody to work for you and increase the value to $5 at the end of 1 year, 2 years, and therefore you make money by creating wealth, not employment. Typical problem I've seen in companies. Creating value for customers is everything, which means ultimately you've got to be obsessed about customers, not about technology, not about the idea, not about competition. If you offer a better or a superior product or service at a lower price, not higher price, in a user-friendly manner, you will always get the customers. That's a marketing 101. If you offer a superior product or service at less than competition prices, which is value, in a friendly manner, service orientation, presentation, there is nobody who can beat you. So those are the ingredients with which you have to think through. I have learned over time, and sitting on the boards of companies eventually, or listed companies, that stock options is a bad currency. It creates unnecessary expectations among employees how much net worth they are when it's all just paper money. It can collapse any day. It's like house of cards that we created by really creating a speculative real estate bubble in 2007 and 2008. We collapsed. Multi-billion, trillions of dollars of wealth was artificially created like house of cards, where the fundamental asset like home was overvalued, and then you multiply leverage on that one through structured instruments, debt instruments. The leverage went from 1 to 50. That's unthinkable. That's speculative. Debt to equity structure should be 1 to 1 at best. Very interestingly, we allowed banks to participate because every fund manager can make money for his own or her own personal gain. So stock options is a bad currency is what I've concluded. If you want to give ownership to employees, do it two ways. Give them the shares upfront, not based on performance. It just doesn't work. Or actually surprise them. You do very well. When you exit, you are a multi-millionaire, and you now say, I don't need all that money. Let me share small pieces with everybody, including the secretary, including the support staff person, including managers, everybody. It's a nice, pleasant surprise. It goes beyond. We says if you just pay the stock options as a currency, what you're doing is that you are not paying the fair wages that are due to the person who works for you. The more you print, therefore, this currency, which is stock options, the less valuable it becomes. In fact, I found sitting on the boards on companies pre-IPO that entrepreneur and the founder does not realize how much complication he or she is creating if they want to do IPO or exit the company, because they signed all those social contracts, if not legal contracts, with employees or with others to give them the shares or share options. Invest your capital in creating assets which have a resale value. In other words, if you're putting assets or if you're putting capital into something, whatever activity you do, make sure that has a resale value. That's very important, I think, as opposed to something that will have no value and is basically an expense. Travel will be an expense. Fringe benefits will be an expense. Nobody will pay anything to you for accumulating fringe benefits, for example. On the other hand, a product is an asset. A brand definitely is an asset, and you can actually exit in creating value. Spend no more than 15% of revenue on sales, marketing, and branding. In the .com area, I found fascinating how startup companies, especially those who were aggregating airline reservations and the seat capacity, went and advertised in the Super Bowl game, which is the American football championship game, one ad, this is like 10 years ago, paying $1.5 million for a 30-second spot in the fourth quarter. Think about that. I mean, I've never seen a dumbness of that kind of spending money. That may be good for a large corporation like Coca-Cola or Anheuser-Busch, which is a beer company, because they have so many other ways to survive. I mean, this is the only cash you have. It is almost like making one big speculative move, and either it works like a home run or you die. And the company did die, actually, interestingly. There is no scale economy in sales and marketing. Even though I'm a marketing professor myself, I don't find any scale economies in marketing. Nor is there any asset value except branding. You might create a brand, and again, if you're a startup company having a brand, the valuation is just not there unless you have made significant revenue and actually significant amount of EBITDA or the profit before taxes. Spend no more than 10% on non-revenue generating management overheads, we call it. This includes rent, infrastructure, automobiles, whatever they are, and the people who are not generating revenue or non-revenue generating, no more than 10%. There is no scale economy in management or any asset value creation. Next point is, I think, very interesting, and there's a lot of debate. Entrepreneurship is solo practice, not a group exercise. You have to have one ruthless driver at the top. So often you have these classmates, buddies who are going through a business school, undergraduate entrepreneurship program, or you have these bright young people who have gone to top engineering schools like Stanford, Berkeley on the West Coast, and similarly other places. They all like each other as friends. They say, okay, let's organize a business now. And they want to be as egalitarian as possible. Collective decision making, it just does not work. You could have very much a what I call autocratic democracy. There is one person who calls the shot, whether you like it or not. And even though you are owner, partner in the company. And usually the entrepreneur is not the most liked person in the company. That's what I have observed. But you need it. You need somebody to make decisive decisions because you are scrambling constantly. There is no time to do strategic planning. There is no time to get a consensus going. So you gotta be a driver. So unless the personality of an entrepreneur is not one of a driver, it has to be one of a driver, you are not likely to succeed in this business, is my observation. And despite all the things you will do right, you will still need luck. In fact, my analysis shows that most businesses succeed by accident, at least 65%, just by being there. Right timing, right place, and the gods were blessing you. Believe in that, please. Okay? Remember in one of those sci-fi movies, you had the Force, may the Force be with you, Star Wars, I think. My view is that we all need superstition. In fact, the most superstitious people in the world are athletes, any kind of thing, from golf to baseball to cricket in India to soccer, any field. Because when one time you did well, you associated by touching the rabbit foot, for example, or carrying that, or picking the cap, or picking the nose even, doesn't make any difference. You create a by association. So now you get into the zone. Inner energy now sort of organizes basically to a level of excellence you couldn't even imagine. So when we say, athlete says, I was in my zone today, that means they somehow psyched themselves up to do extraordinary things, either a play or the game. You need that force. Second most superstitious people I have found are entrepreneurs, because they know they got lucky, interestingly. And therefore they begin to associate that, which is a great idea because that gives them the inner strength to carry on journey despite all of the hurdles and all of the crises that you manage. So may the force be with you. You will need it. Thank you very much. I hope you have enjoyed these observations and the lessons we have learned in entrepreneurship.
Thanks for listening to this lecture on So You Still Want to Be an Entrepreneur with Professor Jagdish Sheth. For more about Professor Sheth and the Sheth Leadership Academy, visit www.shethleadershipacademy.com.